For 30 years, the Bank of Japan has run the most extreme monetary experiment in modern economic history. Zero interest rates, then negative interest rates, oceans of quantitative easing. A central bank that doesn't just buy government bonds, but corporate debt, real estate investment trusts, even stock market ETFs. At one point, it was effectively the silent partner behind almost every major market in the country. And yet, after all that so-called easy money, Japan spent decades trapped in weak growth, low inflation, and staggering public debt. So here's the uncomfortable question that never quite makes it into the official speeches. If money has been easy for 30 years, easy for governments to borrow, easy for markets to float on, easy for asset prices to rise with, who actually paid the price? The answer starts long before the first zero interest rate policy meeting. It begins at the top of a mountain of optimism. In the late 1980s, Japan looked unstoppable. The stock market roared higher, real estate prices went insane, and foreign commentators convinced themselves that Japan had discovered a new model of capitalism. Famous jokes claimed the land under the imperial palace in Tokyo was worth more than all of California. It wasn't just a boom, it was a belief system. The belief that growth was inevitable, that asset prices only moved in one direction, that Japan had entered a permanent high plateau of prosperity. Then, in the early 1990s, the bubble burst, the Nikkei crashed. Property values collapsed. Banks were left sitting on mountains of bad loans that were never going to be repaid in full. Whole sections of the financial system were technically insolvent, but no one wanted to admit it. What followed became known as Japan's lost decade. Growth near zero, deflation or near deflation, and a slow-motion banking crisis that never quite exploded, but also never truly disappeared. Behind the headlines, the balance sheets of corporations and banks were wrecked. Businesses that had borrowed heavily during the boom were now stuck with debts that made no sense in a post-bubble world. Banks pretended bad loans were still good. Regulators looked the other way. Everyone was trying to survive another day, waiting for the old world to quietly reappear. This wasn't a normal recession, it was a balance sheet recession. The private sector wasn't thinking about borrowing more to expand. It was desperately trying to pay down old debts, hide losses, and avoid outright collapse. That's where the Bank of Japan stepped in and wrote the first chapter of the Playbook. In 1999, it did something no major central bank had done in the modern era. It pushed short-term interest rates effectively to zero. That was the birth of the zero interest rate policy, ZIRP. The idea sounded simple and elegant. If you make money almost free to borrow, people will borrow it. Companies will invest and hire, banks will lend, consumers will spend. Cheap money would restart the engine, but an engine with a cracked block doesn't roar back to life just because the fuel is free. Japan wasn't suffering from a lack of available credit. It was suffering from a lack of confidence. Households, watching asset prices crash and job security weaken, chose to save. Corporations, traumatized by their brush with ruin, focused on deleveraging and hoarding cash, not expansion. Banks, still nursing hidden wounds from bad loans, preferred not to take risks. Nobody wanted to speed up. Everyone wanted to repair the damage and avoid another crash. Zero interest rates were supposed to be an accelerator. In a balance sheet recession, they turned into a life support machine. And even that wasn't enough. By 2001, with the economy still weak and prices still flirting with deflation, the BOJ crossed a new line. Cutting rates to zero hadn't achieved the desired escape velocity. So the bank moved to something more radical, quantitative easing. Instead of just setting the price of money, it would now flood the system with money. In plain language, when lowering the cost of borrowing doesn't work, start force-feeding the financial system with liquidity. The Bank of Japan began targeting the size of its own balance sheet. It bought government bonds in huge quantities. It injected reserves into the banking system. It signaled that this ultra-easy stance would stay in place until inflation and growth returned. It tried not just to change today's conditions, but to manipulate expectations about tomorrow. On paper, it looked like a powerful new tool. In reality, it created a strange new financial ecosystem. Banks suddenly found themselves awash in reserves, but still short of borrowers they actually trusted. Corporations still weren't eager to leverage up. Households burned by the bubble clung to saving habits. The liquidity circulated inside the pipes of the financial system, but little of it overflowed into real investment or robust consumer spending. Growth stayed sluggish. Prices stayed flat or slipped. Japan began to resemble something terrifying for other policymakers, a world where a central bank could print and print and print, and still never get the inflation or growth it thought it could engineer. Through the 2000s, Japan cycled in and out of these emergency measures. Zero rates would be ended, then reintroduced. Quantitative easing would be tapered, then ramped up again in new forms. The Bank of Japan became the pioneer of financial tools other central banks would only dare to copy after the global crisis of 2008. But behind the technical language, the core pattern never changed. Whenever the economy stumbled or global shocks hit, The dot-com bust, the global financial crisis, domestic setbacks. The BOJ turned the dial further toward easy. More liquidity, more bond purchases, more promises that rates would stay low for as long as it takes. It was like treating a chronic illness with a single drug, more morphine. The pain goes down, the patient stops screaming. But nothing inside is truly healed. Then, around 2012, Japan tried to rebrand the entire experiment. A new prime minister arrived with a grand project, a three-arrow strategy that would be marketed to the world as Abenomics: fiscal stimulus, structural reform, and at the heart of it, massive monetary expansion. The Bank of Japan, now under new leadership, launched quantitative and qualitative monetary easing, QQE. QQE wasn't just easing, it was monetary shock therapy. The central bank didn't simply buy more government bonds. It went further out along the maturity curve, buying longer-dated bonds. It bought exchange-traded funds that tracked the stock market. It bought real estate investment trusts. The central bank's balance sheet grew until it became one of the largest in the world relative to its economy. Japan's monetary authority was no longer just the lender of last resort. It was becoming one of the largest, most persistent buyers in multiple asset markets. On the surface, markets cheered. Stocks rose. Bond yields stayed pinned at low levels. Volatility dropped. The message was clear. The central bank was all in, and it would not allow a serious crisis in the bond market or a deep deflationary spiral if sheer printing power could prevent it. But inflation still refused to cooperate. By 2016, with prices still stubborn, the Bank of Japan pushed into even stranger territory. It introduced negative interest rates on some reserves, effectively charging banks to hold money at the central bank. And then it unveiled a powerful new tool, yield curve control. It pledged to keep the 10-year government bond yield anchored around 0%, buying or selling as many bonds as necessary to enforce that outcome. Think about what that means for a moment. For years, the price of money in Japan, not just overnight, but out to a decade, was no longer a result of millions of independent decisions in the bond market. It was, to a large extent, a number declared by a committee backed by the threat of unlimited printed money. The central bank became the referee, the dominant player, and the scorekeeper all at once. That's the heart of the BOJ playbook. If growth is weak, cut rates. If rates hit zero, print money. If printing isn't enough, buy everything. If markets still wobble, control the entire yield curve. From the outside, this looked like the purest version of easy money humanity had ever seen. But easy for whom? Despite decades of near zero rates, repeated rounds of QE and QQE asset purchases, and yield curve control, Japan never returned to the high-growth miracle days that made it famous in the post-war period. Instead, the economy settled into a kind of low-temperature stability. Real growth averaging around 1%, inflation hovering near zero or quietly negative, wages barely moving for large parts of the workforce. Public debt, on the other hand, exploded. Japan's debt-to-GDP ratio climbed to levels that would trigger panic in most other countries. In Japan, it became the new normal. So what did 30 years of easy money really do? It kept the government funded at ultra-low cost. It allowed deficits to roll on year after year without an immediate bond crisis because the central bank stood ready to buy what others might hesitate to hold. It helped zombie companies survive that might otherwise have failed by keeping their borrowing costs artificially suppressed. It inflated the price of financial assets, from bonds to stocks to real estate, benefiting those who already owned them. And it quietly punished savers who sat in cash or low-yield deposits, watching real returns evaporate. Easy money turned into a long-term mechanism of wealth transfer, from cautious savers to indebted borrowers, from households holding bank accounts to institutions holding assets, from future taxpayers, who will have to navigate the consequences, to present politicians, who gained breathing room. The official story is always the same. These policies are necessary to escape deflation, to support employment, to stabilize the system. The emergency measures are presented as temporary bridges to a better future. But when an emergency lasts 3 decades, it stops being a bridge and becomes the landscape. Defenders of the BOJ's strategy argue that without these extreme measures, Japan might have suffered vastly worse outcomes. Depression-level unemployment, cascading bank failures, social unrest. They point to episodes where easy money likely prevented acute crises and argue that the true comparison is not Japan now versus some ideal world, but Japan now versus a Japan that did nothing. There is truth in that. Yet that truth doesn't erase another one. Easy money did not fix the underlying problems. Japan's population kept aging and shrinking. Its labor markets remained rigid in key ways. Corporate culture stayed risk-averse, favoring cash hoards over bold investments. Entire generations grew up in a psychological climate where growth was not expected, and where security was valued over dynamism. Easy money did not rewrite those deeper forces. It simply made it painless to avoid confronting them. It is like repeatedly painting over cracks in a wall instead of repairing the foundation. From the street, the house looks fine. Up close, the fractures are still there, hidden under layers of expensive paint. Now zoom out beyond Japan's borders. After the global financial crisis in 2008, and again after the pandemic shock, other central banks dipped into the same toolbox. The Federal Reserve, the European Central Bank, the Bank of England, and others slashed interest rates to zero or near zero. They launched massive quantitative easing programs. They guided markets with promises about how long rates would stay low. Some even flirted with negative rates. For years, policymakers around the world told themselves that Japan was an exception. A unique mix of demographics, culture, and history, something that could be safely observed from afar but not replicated at home. Then they watched their own institutions copy the BOJ's playbook almost line by line, but at record speed. There is one crucial difference. Many of those central banks, especially after inflation spiked in the early 2020s, were forced into a rapid reversal. They raised rates sharply. They began shrinking their balance sheets. They openly admitted that ultra-easy money had played a role in fueling asset bubbles and inflation. Japan never had a clean exit ramp. The longer the experiment ran, the more every part of the system adapted to it. Banks, insurers, pension funds, all of them organized their business models around permanently low rates and a central bank willing to tame the bond market whenever trouble appeared. The government relied on cheap funding. Households learned to live in a world where savings earned almost nothing in nominal terms. When easy money becomes the operating system, turning it off becomes dangerous. In recent years, under new leadership, the Bank of Japan has begun cautiously to step away from the most extreme parts of the playbook. Yield curve control has been adjusted, then loosened. Hints of rate normalization have appeared. Internal reviews have quietly suggested that years of radical easing had smaller effects on inflation expectations and consumer psychology than planners hoped, while creating serious distortions in the bond market and compressing the health of the financial sector. Put simply, 30 years of easy money bought time, but not transformation. When the institution that wrote the playbook begins to question its own legacy, the story shifts from heroic experiment to cautionary tale. So, what does this playbook actually teach? First, easy money is never truly free. Zero rates look like mercy for borrowers, but they are a slow tax on savers. Quantitative easing supports markets, but it pushes wealth toward those with assets and away from those living on wages or fixed incomes. Yield curve control keeps government borrowing cheap, but it hollows out the bond market, replacing genuine price discovery with policy decree. Second, money can be made easy, time cannot. You can borrow against the future with deficits and central bank balance sheets, but at some point the bill arrives, whether through distorted markets, fragile institutions, social discontent, or younger generations forced to navigate in a world where every major lever has already been pulled to its limit. Third, and most important, monetary policy can move numbers on a screen. It cannot, by itself, rebuild trust, reverse demographics, or change national psychology. Japan's corporations continued to hoard cash. Its households remained cautious. Its political system struggled with deep structural reforms. Easy money could dampen the pain of those realities. It could not change them. And that is where this stops being a story about Japan and starts becoming a mirror. If a country keeps interest rates artificially low for too long, if it relies on its central bank to rescue markets whenever they stumble, if it piles up debt because borrowing feels painless, if it treats quantitative easing and other extraordinary measures as routine tools rather than true emergencies, then it is no longer just watching the BOJ playbook from a distance. It is running its own local adaptation. Easy money is seductive because it feels like solving problems without sacrifice. No visible tax hikes, no dramatic spending cuts, no obvious crisis, just liquidity. Japan's last 30 years show the other side of that bargain. You get a surface calm over an economy that never quite heals. You get stability that lasts right up until the moment you try to exit the experiment. And when that exit finally becomes unavoidable, you discover how much of your apparent prosperity was real and how much was simply the side effect of a central bank willing to stand in the shadows and buy everything in sight. Every country tells itself that its money is safe, its debt is manageable, its central bank is in control. Japan told itself that too. The record of the last 3 decades is a quiet warning. Easy money can keep the system afloat for a very long time. It cannot, on its own, fix what is broken beneath the surface. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.